Welcome back to the deep dive. We've got the latest ICICI Bank analyst call notes and investor docs here. Q2 FY26 results dated October 18th, 2025.
Right. And our job today really is to cut through all that density.
Exactly. We want to give you, the learner, the key takeaways, performance indicators, strategic priorities, and, any interesting shifts we spotted.
And it helps that they lay out their strategy pretty clearly up front. It frames everything else.
What's the core message there?
Their stated goal is growing profit before tax, crucially excluding treasury gains. It's all about risk-calibrated growth.
Okay.
So that means leaning on that 360-degree customer view, using digital platforms, serving specific ecosystems, and maintaining strong governance.
Right. That PBT excluding treasury focus is key.
Right.
Let's start there then with Section 1, the big picture financials. The core engine seems pretty strong.
Absolutely. That headline number, profit before tax excluding treasury, it grew 9.1% year on year. That's $161.64 billion. That's what they see as the sustainable part.
Okay, 9.1%. And the mechanics behind that, core operating profit, solid. Up 6.5% year on year to $170.78 billion. That's your revenue minus operating costs before provisions and that tricky treasury bit.
Got it. And the bottom line, standalone profit after tax.
PATA was up 5.2% year on year, so $123.59 billion, still growing nicely.
And consolidated PATA, including the subsidiaries.
That grew a bit slower, 3.2% year on year, landing at $133.57 billion.
Okay, so let's talk revenue drivers. How do they make that money? Net interest income first.
Right. NII, that's your bread and butter loan interest minus deposit interest. It climbed 7.4% year on year to $215.29 billion. Steady growth there.
But the non-interest income line, excluding treasury, that looked like the real action was happening.
Yeah, that jumped quite a bit, 13.2% year on year, hitting $73.56 billion. That's impressive growth in fees and services.
And digging into that a little, fee income specifically.
Fee income grew 10.1% to $64.91 billion. And here's the interesting part, tying back to their strategy.
78% of those fees came from retail, rural, and business banking customers. Think transaction fees, card fees, digital platform usage. It shows that customer-centric ecosystem approach is really paying off. It's sticky income.
That is a strong signal, isn't it? Okay, but we have to talk about the elephant in the room now, Treasury. You mentioned it was tricky.
Tricky is putting it mildly. It basically fell off a cliff sequentially.
How bad was it?
It went from $12.41 billion in Q1 down to just euro 2.20 billion in Q2. That's a huge swing.
Wow.
And really underscores why they emphasize the core profit excluding treasury. That part is volatile.
What drove that massive drop specifically?
It was mainly rising yields on fixed income securities. Bond yields went up, so the value of the bonds they already held went down. Mark-to-market losses, basically, or just fewer trading gains.
Right. So a reminder for you listening, strong operations can sometimes get masked by these big macro shifts like interest rates.
Exactly. It's not necessarily a reflection of the core banking business itself.
Okay, great context. Let's move on to how they're funding this growth. Section 2. The balance sheet deposits and margins. Can't lend without deposits.
Precisely. And deposit mobilization looked pretty healthy. Average deposits grew 9.1% year on year, reaching almost $15.6 trillion.
Quality of those deposits, cash current and savings accounts, that's the cheap stuff.
Yeah, cash is key. Average CASA deposits grew 9.7% year on year. Current accounts actually led the way, up 12.6%, while savings grew at 8.5%.
And the overall CASA ratio?
It held up reasonably well. The average for the quarter was 39.2%.
And that stability seems to have helped with costs. I saw the cost of deposits actually dipped sequentially.
It did. Dropped to 4.64% in Q2 from 4.85% in Q1. In this environment, managing funding costs that effectively is quite positive.
Which brings us to the net interest margin, NIM, the profit margin on lending. Where did that land?
Overall NIM was 4.3% in Q2. Very strong, though a tiny dip from 4.34% in Q1.
Still north of 4.3% is quite something. Domestic NIM.
Even better, actually, 4.37% domestically.
Okay, but holding on to those margins is tough, right? Especially with loan competition. How sensitive is that NIM to rate changes? Let's talk portfolio structure.
Yeah, this is really important, and it feeds into our final thought later. So about 55% of their domestic loans are linked to external benchmarks, like the repo rate. They reprice fairly quickly.
Okay, so more than half adjusts with market rates. What about the rest?
Well, that's where the potential squeeze comes in. A significant chunk, 31%, has fixed interest rates.
31% fixed.
Exactly. And another 14% are linked to older, slower benchmarks like MCLR. So that 31% fixed portion, If their deposit costs rise, they can't quickly pass that on through higher interest income on nearly a third of their book.
Right. That's the structural challenge for margins right there. Okay, challenge identified. Let's move to section 3. Loan portfolio and growth engines. Where's the money actually going? Overall loan growth was
10.3% year-on-year for total advances. Domestic loans grew slightly faster at 10.6%. Solid, but not the really exciting part.
Okay, so what was the exciting part? The aha moment for you, the learner.
Business banking, without a doubt. The growth there was, frankly, explosive.
How explosive?
Up 24.8% year-on-year, almost 25%. And even sequentially, quarter-on-quarter, it jumped 6.5%. That's huge momentum.
Wow, 24.8% year on year. What's driving that specifically? Is it sustainable?
It looks quite strategic. They mentioned focusing on parameterized program-based lending, think standardized, efficient credit for SMEs, and they're heavily leveraging digital platforms like InstaBiz in Merchant Stack.
So it's tech-enabled scaling into the SME space.
Exactly. It's efficient, likely higher yield, and it ties back into that strong fee income growth we talked about earlier. Seems built to last, assuming the credit quality holds up.
Okay, makes sense. What about the biggest chunk of the book, retail? That's still over half the loans, right?
Yep, 52.1% of the total loan book. Retail growth was more moderate, 6.6% year-on-year overall.
Any standouts within retail?
Mortgages grew steadily at 9.9% year-on-year. Stable anchor there. But credit cards showed really strong sequential growth, up 8.4% just from Q1.
Another high-yield segment showing momentum.
Precisely. But not everything in retail was booming.
Like what?
Well, personal loans actually dipped slightly, down 0.7% year-on-year. And the rural portfolio, while it grew a tiny bit sequentially, was down 1.3% compared to last year.
So it looks like a deliberate pivot, pushing hard on business banking and cards, maybe easing off a bit on unsecured personal loans and rural for now.
That seems to be the pattern, yes. Prioritizing tech-driven, higher-margin segments.
And the corporate side, wholesale lending.
Pretty conservative growth there. The domestic corporate portfolio grew just 3.5% year-on-year. But the key point on corporate is risk management.
Concentration risk low.
Very low and still declining. Exposure to their top 20 borrowers is down to 6.7% of total exposure.
Yeah.
And crucially, all 20 of those top borrowers are rated A or better internally. That's strong quality control.
Good to hear. Any flags on specific sectors, like NBFCs or real estate?
They gave the numbers. NBFC and HFC exposure was about 4.4% of advances. The builder portfolio was 4.1% of the total loan book. Pretty standard levels. Seems well managed.
Okay. That naturally leads us to section 4, risk, asset quality, and capital. If business banking was the aha, this seems like the few part, asset quality looked much better.
Dramatically better, yes. It's a really strong point this quarter. Gross NPAs non-performing assets fell to 1.58%. That's down from 1.67% last quarter.
And net NPAs?
After provisions.
Even lower, down to 0.39% from 0.41%. Sub 0.4% is excellent. But the really impressive number is about new stress.
The flow into NPAs.
Exactly. Net additions to gross NPAs, excluding any write-offs or sales, absolutely plummeted. It went from over $30 billion in Q1 down to just under $14 billion in Q2.
Wow, less than half the new stress compared to the previous quarter. That's significant.
It really is. Now, management did mention some seasonality. Apparently, Keystone credit card, KCC, NPAs tend to spike in Q1 and Q3, so part of it is seasonal timing.
Okay, point. But even accounting for that, a drop that sharp suggests underlying underwriting is holding up really well, especially in those fast-growing digital segments, perhaps.
And better asset quality means lower provisions needed.
Correct. Provisions for the quarter dropped significantly to $9.14 billion, way down from $18.15 billion in Q1, and the provision coverage ratio on the existing NPAs is strong at 75.0%.
Plus, they have that extra buffer, right? The contingency reserves?
They do. They're still holding $131 billion in contingency provisions. That's about bubble 0.9% of their entire loan book, just sitting there as an extra cushion against future shocks. Very prudent.
And capital levels, plenty of buffer there, too.
Oh, yeah. Capital adequacy is robust. CET1 ratio, that's the core equity, is 16.35%. Total capital adequacy is 17.00%. Both way above the minimum requirements. They have plenty of firepower for more growth.
Okay, strong core bank performance, improving asset quality. Let's quickly cover Section 5, key subsidiaries. Can't forget them.
Agreed. Important for the consolidated picture. Let's start with ICICI Pru Life Insurance.
What's the story there?
The key metric, value of new business or VNB margin, actually improved quite nicely. It hit 24.5% for the first half of this fiscal year, up from 23.7% last year.
So even if the total value of new business written was kind of flat, The business they are writing is more profitable.
Exactly. It suggests a focus on higher margin products, quality over quantity, which is strategically smart in insurance.
Okay. What about ICICI Lombard General Insurance?
They had strong profit growth, PA up 18.1% year-on-year to 8.2 billion. Operationally, their combined ratio is worth noting.
That's claims plus expenses divided by premiums, right? Lower is better.
Right. Ideally under 100%, theirs was 105.1%.
So paying out a bit more than taking in from underwriting alone.
But if you strip out catastrophe losses, it improves to 103.8%. And given the strong PAT growth, it suggests underlying claims trends are manageable and investment income is helping deliver that profit. Overall, still positive.
Got it. And lastly, the brokerage arm, ICICI Securities.
That was the one subsidiary showing a year-on-year decline. Consolidated PT fell to euro 4.25 billion from euro 5.29 billion in Q2 last year.
Any reason given? Market conditions.
That's the likely culprit. Brokerage profits are very sensitive to market volumes, trading activity, IPOs. With treasury yields rising in the quarter, maybe market sentiment cooled a bit. It's volatile, not unexpected to see dips.
Okay, provides a bit of balance to the overall picture. So let's wrap this up. Synthesizing the whole quarter for you, the learner.
I think the main narrative is that core operational strength continues. That engine, profit before tax excluding treasury, is humming along nicely.
Driven particularly by that business banking surge, which looks linked to their digital strategy paying off.
Right, and underpinned by that really encouraging improvement in asset quality, especially the sharp drop in new NPA additions. That's a very healthy sign.
The treasury income volatility, it's just noise around a solid core, really, a reminder of macro factors.
Exactly, which brings us back neatly to that tension we flagged earlier.
Between growth and margins.
Yeah. They've got great momentum in high-yield areas like business banking and credit cards. Fantastic.
Yeah.
But we noted 31% of the domestic loan book is fixed rate.
Can't reprice quickly if funding costs go up.
Right. And competition for low-cost CASA deposits is fierce. So funding costs are under pressure.
Which leads us to the final provocative thought for you to chew on. How long can ICICI Bank keep delivering these really strong net interest margins, given that fixed-rate loan book chunk, the push for growth, and the rising cost of funds in this rate environment? Something has to give eventually, doesn't it?
That interplay fixed assets, potentially rising funding costs, and margin pressure, that's definitely the dynamic to watch in the coming quarters. Q3, Q4 results will be telling.
A fascinating balancing act. Well, that's our deep dive for today on the ICICI Bank results. Thanks for walking us through it.
My pleasure. Always interesting to unpack these numbers.
Indeed. We'll catch you next time on The Deep Dive.